My guest today is a Doyen from the mutual fund industry. In fact, he's managed one of the largest mutual fund franchises in India for many years, even decades. Prashant Jain, Chief Investment Officer of HDFC Asset Management Company, joins us now. Prashant, it's good to see you again. It's an interesting time for the market as well, because after many months and quarters, we have a whiff of a correction, and of course it's brought about by another variant of the pandemic, or the variant of the COVID virus again. Do you fear at any level that these successive waves which are coming about, just when you think that you've seen the worst of the pandemic, could dent the confidence in an earnings recovery and in a market recovery which had come about and taken hold over the last many months?
So, Udayan, I'm an optimist by nature, and I think the way we have recovered from the first wave and even the impact of the second wave on the economy and on the markets was quite limited. So I feel optimistic that the third wave will also pass. Of course, I mean, sometimes the inconceivable is possible, but I don't see this derailing the economy or the profit growth. And what I've also observed is that events that are anticipated by the system, by the infrastructure, by the governments, the regulators, by the markets, and when the system is on its guard, so to speak, then seldom that risk attaches itself meaningfully. And after the experience of last 2 years, I think the entire system world over is on its guard. So I think it is unlikely to my mind that this should cause any material challenges.
The other risk which is known to the market, but which is also causing some apprehension, is the prospect of interest rates going up next year, both globally and in India. Would you say the same that you just said of the COVID, that of this variant, that it is also a known risk and therefore it should not derail the market significantly, or is it too fundamental to be ignored?
Oh, there, I think it depends on the time frame what you talk. See, if you take a longish view of India, then we have lived with far higher interest rates, both locally and even in US. I mean, as recent as 2005, the US 10-year yield was about 4%. And even if you look at the economic growth prospects, then they were quite reasonable in India. So I would say increase in interest rates globally at least is widely anticipated, and to that extent, in line with what I said earlier, it should not have a significant impact on the markets. But then markets are prone to short-term corrections every now and then, and short-term in the markets is extremely hard to forecast. Also, we need to keep in mind that on the external side, India's fundamentals are actually quite strong. So even if there is some disruption in capital flows, I don't think the economy should get impacted. But stock markets are always prone to short-term change in flows or sentiment. So, but medium to long term, I think we should be able to handle that reasonably well.
So let me ask you a long-term question then, Prashant, because you are a long-term investor at heart. What about the other risk in this market, which is valuations? Because we've seen that over long periods of time, when you enter the market at a average P multiple of, which is close to the average, which is 15, 16 for India, your returns tend to be over the longer term close to that, 15%. But when you buy at a P multiples of over 20, often the long-term returns are also quite subpar. They are not 15, 16%. Is that risk present in the market today, that investors who are entering today should not expect very high returns, that they should moderate their expectations because of the entry point?
Then I think that's a point extremely well made, and I would agree with you almost in entirety, that these are markets which are close to fair valuations. If you look at the last 10-15-year returns, markets have yielded about, I think, 13 and 11% CAGR respectively, which is in line with the nominal GDP growth over the last 10 and 15 years. India's market cap to GDP or PE multiples are also closer to long-term averages, maybe 10% higher or 10% lower. So I would agree with you that from here onwards, medium to long term, we definitely need to moderate our return expectations and not go by what has happened over last 2 years. And returns, to my mind, should be in line with the nominal GDP growth rates. Just two things more I would like to point out here. If this cost of capital stays lower than longer term averages for a while, it could be mildly supportive of higher multiples. And second, I think more important is that over long periods, it is the growth which is the real driver of returns and not variations in multiples. I mean, you can go back and see, the Indian markets have been at high P's, at low P's. Yes, near term, the returns can get impacted, but over really long periods, it is growth which is the real driver of returns, and the impact of change in multiples is actually quite small.